confirmed. Well, time now to get more on all of this with George Lucas from Instreet. And George, thanks so much for joining us on the program.
Thank you for having me.
Let's start with that credit crunch in China, or the narrowly avoided one, so the reports would tell us. Certainly gave markets a bit of a rattle. A lot of people attributed the big sell down we saw just to the Fed, but it wasn't just about that, was it?
No, but we've got to remember that it's a self-made credit crunch. It's not like there's a crisis and banks don't want to lend to each other. It was that the Bank of China just refused to put liquidity in the market for a few weeks until Friday when the interest rates pushed up. So, the Bank of China was always in control, and I think they're just sending a message to their internal banks that they want to have more restraint on the credit growth, because they've had quite a massive credit growth over the last 12 months, and obviously the Bank of China is not happy with that. And
but it's not that official part that they're trying to restrain, it's the shadow banking industry which operates outside that.
Well, the interbank lending part was actually the official part. They were trying to control the credit growth in the official part of the banking. They're sending a message to those banks, I think, because I can't understand any other reason why the Bank of China would let the interbank rates rise so high. But the shadow banking is obviously an issue for them. They've begun to bring down more controls, and that started about 2 or 3 months ago on the shadow banking side. And that's also part of the credit growth, because we've got to remember that a lot of this shadow banking is actually driven by the official banks as well. They just don't run it across their balance sheets.
Yeah, okay, so China, a major concern last week. Are we now going to be looking at lower growth because of, the PBOC's reluctance to continue to inject cash in when these kind of credit squeezes occur? I
don't know. Well, we're not going to be looking for growth. I think a lot of investment banks had growth in excess of 8%, and I think we're going to get growth more in line with what the Chinese predicted, which is around 7.5%. The interesting thing is, if we're having this conversation a month ago, fund managers' biggest fear was Europe. Now their biggest fear is China growth. And so it definitely has moved up, and it's going to be a story which is going to stay with us for a few months, if not for the rest of the year. But there has been massive credit growth over the last 12 months, so it'll be quite interesting to see, and it takes time for that to filter through to growth. So it'll be quite interesting to see if we actually see a bit of a pickup for growth in China. We haven't yet on the back of that credit growth, but you may see a bit of a pickup at the end of the year in China growth, so that they will come in around somewhere between 7.5 and 8% growth.
Yeah, okay, let's move over to the United States. Obviously the FOMC was the main game last week. Were you surprised how negatively markets reacted to those comments out from Bernanke?
Yeah, I was actually a little bit surprised. I thought we would have seen markets react more like that when they first started doing the tapering, rather than when they just announced the tapering. But we've got to remember also there was a bit of volatility around the end of last week due to the what we call the triple witching or quadruple witching in the States. We also had the same thing happen here in Australia. So that added to the volatility, but I am quite surprised how nervous. But the world has changed, and we have gone from a world for the last 5 years where we've seen yen strength against US dollar weakness to a world where we're seeing US dollar strength and yen weakness. And obviously the comments out of the Fed just support the US dollar, and so that's creating a lot of capital flow changes in the way people want to invest their money, and there's going to be a bit of volatility with us until that settles down.
Okay, now George, this week pretty quiet locally. We don't have any top line data, or really any data at all, out for the first few days of this week. The United States not so much. They've got some data out there. They'll also have some members of the Fed speaking as well. Are all eyes over there this week, or is there some things that you're keeping an eye on here at home?
There's not really much for keeping an eye on at home. I mean, a couple of interesting trading patterns came out of last week, so it'll be interesting to see if it continues. And really only for Thursday, what we always saw was that the Australian equity market got sold down on the open as foreign players sold it down, and then we saw Australian institutions and Australia's buyers come and buy it back up. So that trend may continue, it may not. It didn't happen on Thursday, it did happen on Friday. For Australia, Japan's going to have a big rush of data coming out at which they always do, and that Japan's becoming more and more important. We've kind of put Japan away for the last 20 years, but it is still the third major economy, or third largest economy, and it is showing signs that it could start growing again. And if they can actually break this back of deflation in Japan, Japanese growth can easily make up for any slowdown in growth expectations from China.
Yeah, and I should mention we saw a bit of a run-up for Japanese equities on Friday, and at the moment futures are telling us we're looking at strong gains again there today. I guess we expect this volatility to continue.
Yeah, and it's really, that seems to me where a lot of the volatility is coming, especially for our time zone, because Japan is our major market that we follow, that we will, and it's been very volatile. And again, on the back of this fact that capital's trying to work out where they want to park their money.
Yes.
And until that begins to get a bit more stability in Japan, you know, the volatility probably will continue here in Australia as well.
Okay, the Australian dollar sitting just above that 102 mark right now. Do you see any stark moves to the downside over the next couple of weeks?
Yeah, well, it's going to get, the global expectation is for it to get below 90 cents, so we will continue to see it start moving down that trend again, and we have seen that over the last couple of months. Every time it does rally, it gets sold back down and making lower lows. And so, you know, we're very close to that 90 cents level, and in some ways, the quicker we get there, the better for our markets, because then the expectations globally would have been met. But we can still see it continuing just to trend down and to make this 90 cents level. Whether it does it in a day or whether it does it over 2 weeks, I don't know.
Okay, George Lucas from Instreet, thanks for joining us on the program.
Thanks very much for
having me.
having me.
Have a great week. All right, it is time for a quick break. When we come back from the banking crisis in China to the crisis in Europe, we'll bring you the details of the failed bailout talks among finance ministers.
Have you been ignoring your super? Well, if so, you could have multiple super accounts and unnecessary fees could be eating into your balance. That's your hard-earned money. BT's free Super Checkup makes it easy to get on